You're listening to The R.E.A.L Show with Kathy Fettke, the real estate investor's resource.
Fantastic. All right. Well, now let's look at the steps of, there it is, investing in a fund.
Okay.
Yeah.
Great.
So,
Yes.
Well, I'll hand this to you, Adam.
Okay. Thanks, Kathy. So, very similar to the other steps, but step one is research fund managers and investment strategies. Ultimately, there's a lot of different types of funds with a lot of different strategies, and you want one that identifies with, what your core values and your core investment strategy, what you think is going to make sense. You want a fund manager that has experience in working with that asset, and you want that fund strategy to be aligned with where you feel like the market's going or what you feel like is going to be a successful purchase. So that's the first step, knowing a little bit about the details and what you're doing. The second step is understanding the fund return structure and the timelines. So every fund has a beginning when it starts and has an ending. They all have shelf lives. And so that shelf life has to align with your investment strategy. And so as far as the fund structure, Kathy mentioned a couple of things earlier about reading through the private placement memorandum, that PPM, and reading those documents so you can understand what the minimum investments are. You can understand, how you get paid, how they get paid, and there's usually a waterfall structure at the end, and just getting to know the details and the benefit. And I know you've probably seen a prospectus from some of your retirement accounts or things like that. So they're usually not that long and it's not as boring. But I would encourage you just to read the entire thing. Make sure you're going through that, which is step three, going through your offer memorandum or your PPM, understanding the company and what their role is, and just getting to know those details. We mentioned before, when you have a property or properties that are being managed by a property management company, you still have to manage that management company. It's still important. Those are your assets and your capital. It's important to know what it's doing. And reading that material and understanding the details of what's going on will serve you throughout your entire lifetime of being an investor. But it's not going to serve you well to just put it in there and to not know what's going on. Even, and this relates to your personal finances as well. Step four is basically you'll have some paperwork involved, and so call it like a subscription agreement or things like that. And basically there'll be some paperwork for you to fill out. You'll have to document a few things, and we'll talk about that in just a second, but it's just filling out the paperwork and then waiting for approval. Once you get approval, you can wire the funds into an escrow account or into the fund account, and that's it. Now, step five, let's say you've all the paperwork's done, you've wired the money, the fund timeline has started, and the fund is now executing their strategy. Now, what's going to happen is basically as the fund deploys capital and executes strategies, if it's a cash flow fund, you're going to receive oftentimes monthly, quarterly, semi-annually, or annually capital distributions. And again, we talked about having a pref. If there's a pref in it, that means you would get paid first. So in the example, if there's a quarterly statement, you'll get a financial statement that shows where the money went, and how much basically how much was invested in the asset, on expenses, and a number of different line items. And it goes through, honestly, similarly, it'll look just like your financial statement you get for your stock portfolio, your mutual funds, or your retirement accounts. It'll show what kind of returns, how much capital went out, how much income's coming in, and you'll get one of those. You'll get one of those every time you get a distribution of capital on whatever scale it is. And in this case, often it's quarterly. You get a quarterly statement with your quarterly distribution. And you want to review those. You want to understand what's happening and know what's going on so that you can make important decisions. And on the future, that you can have some experience. And when this fund timeline ends, whether it be 2 years, 5 years, 10 years, 20 years, wherever the life is of the fund, you'll be able to make informed decisions because you'll know how it performed. But those are the steps. And you can tell from these steps that it is a lot more passive than managing and owning it yourself, but there's still work involved on your part.
Yeah, absolutely. All right. So a lot of our members have already been familiar on how the whole raising capital process works. If you're basically the way that most smaller funds are able to file is through Reg D, unless they're a big institutional company. They do it the regular way with the SEC. They file with the SEC, but there is this exemption called a Reg D, Regulation D, and it allows smaller companies to be able to open funds as long as they follow the guidelines, and they still have to register with the SEC, but they don't have to. Uh, they're not under as much scrutiny as, say, a broker dealer. So most of you know that the syndications and the deals that, all the larger deals that we've done as a group, the funds that we've done in the past at Real Wealth Network have been filed under Reg D 506B. And that is the old traditional way of doing private placements and yeah, basically smaller funds. It's up until the new crowdfunding laws came in place through the Jobs Act. Most companies, most small companies, private companies would raise money through the Reg D 506B. And the way that works is it's supposed to be all accredited investors, accredited meaning you have $1 million net worth, or you earn $200,000 as an individual or $300,000 as a couple for 2 years straight, not including your home equity on any of that. Then you can participate in one of these fundraisers or in any of these funds. But the Reg D 506B does allow 35 non-accredited investors, basically sophisticated investors, to participate. And the only other requirement is that there has to be a prior existing relationship that is not really defined of what that means. Does it mean I met you 5 minutes ago and now we have a prior existing relationship? A lot of the crowdfunding sites have different ways that they define that when they use the Reg D 506B. But the way that most companies feel comfortable is that if there were 3 touches, meaning you had a phone call or an in-person meeting, you joined maybe online, you joined a group, or you responded to an email, just 3 different ways that you've had contact with that company, and that could be considered a prior existing relationship. So at Real Wealth Network, the way we define it is we want, all those things for sure, but we want to know that you are a member of Real Wealth Network. So you've gone to Real Wealth Network, you've signed in, logged in, you are a member. That definitely shows prior existing relationship because our website is able to track when that happened. And then additionally, to make sure we're totally compliant with the SEC, we want to have had a phone call with you. We want to have a conversation, know who you are, what you want, what your situation is. We'd ask a few questions so that we really truly can say we have a relationship, not just an email exchange. And that it can be done either through a strategy session with one of our investment counselors, or contacting anyone at the company and having a conversation. So if you haven't done that yet and you are interested in being involved in any of our future syndications, then you definitely want to go to Real Wealth Network, join, and talk to somebody. Sign up for a strategy session. This strategy session can take 15 minutes, but now at least we've built this relationship. Or come to an event and talk to us, get to know us. We would register that, and then again, we could prove to the SEC we have a relationship. And so if you go back to the last slide, I'll then talk about that one. Then the Jobs Act came out with this groundbreaking crowdfunding platform called the Reg D 506C. And that was a big change in securities law that allows companies to raise money and not have a prior existing relationship. So that means for the first time in, as far as I know, in SEC history, companies who wanted to raise money could go to the public and do advertising, and I could talk about it on my podcast and put out ads for it. Basically, you can just advertise and go public, and people can invest who don't know you. And that's how the crowdfunding platforms came about, where people could just post their investments and a stranger could invest in them. That's the whole crowdfunding thing, which comes with all kinds of risk because you really don't have a prior existing relationship. Now, the government wanted to make sure that this little guy was protected. So they went a little too far, in my opinion, and said, you know what, the little guy just can't, we're going to protect the little guy by not letting them participate. So that's the bummer of the Reg D 506C, is you have to be accredited and you have to prove it. So anybody who's been involved in our most recent fundraise for a high-tech startup, we were advised to go with the Reg D 506C on that one, where we could only accept accredited investors, and they had to prove it through a third-party verification. And there were a lot of people angry at us for that, but don't be mad at me. Go to Dodd-Frank and talk to them, and go to the regulators of the SEC, because that's what they came up with. Now there's another one that is called Title III. I didn't even bother to put it on here because we'll never use it. It allows companies to raise up to $1 million with anyone, from anyone, any amount. You don't have to be accredited. You could be non-accredited, but you can only raise $1 million, and there's a massive, massive amount of paperwork and regulation for that Title III. So for a company to raise $1 million and have to be treated like a hedge fund on Wall Street with all the paperwork, no one's going to do that. So it was an attempt at opening up these offerings to everyone, but very, very restrictive. So we don't even put it on there. So basically you want to know these things so that when you talk to any provider, anybody, any fund, that you find out how it was filed. And you want to make sure you've done it right, because with the 506B, it's mostly accredited investors, but you get to self-verify. You don't have to go to a third party to verify that you are indeed accredited. It's kind of like a stated income loan, whereas the Reg D 506C, you have to prove it. There's one other thing, and a lot of people had questions about this on our last fund, and that was only 25% of funds received can come from retirement funds. So that's something you're going to have to check in. If you hope to invest in a fund, you need to ask them out, have they hit their 25% limit? A lot of people we had to turn away for our last fundraise because we got our max really early on. All right, next slide. Unless you guys have anything to say about that, but here's the investor suitability stuff. Want to go over that, Adam?
Yeah, so one of the things that I want to touch on, something that Kathy mentioned earlier that's pertaining to this slide, is that pre-existing relationship is really important. It's really important that you talk to your investment counselor, or at least start that call. It's not going to cost you anything, but it can make you a lot, because you don't want to miss out on an opportunity that comes by, like investing in a fund or a syndication or something like that, and you hadn't done the work ahead of time just to pre-qualify yourself in that manner to be able to take advantage of it. So, and it's for investing in these type of assets, you're looking at accredited investors, those that have annual incomes of $200,000 single or $300,000 as a couple, net worth excluding the primary residence, like Kathy mentioned, of $1 million. Now, a sophisticated investor is a little bit more vague. I'm going to read this little blurb for you. Sophisticated investor is one who, by reason of their background, education, business, sport, financial experience, can be reasonable to assume that they have the capacity to understand the fundamental aspects and merits of the investment. So basically, this is not someone who's brand new to real estate or brand new to investing or these concepts. This is someone that has a little bit of experience and has done something, or at least has the aptitude to understand what's going on. And at Real Wealth Network, we look at here as annual income of $150,000, net worth of $350,000, and to make sure a sophisticated investor. So that way, it's kind of giving you a specific window and a bridge that you could come in on. So if you qualify in this manner, you can invest in these assets, and if you don't, work with your investment counselor and help you get to that qualification stage.
Great. All right. So every investor, as I said, has different needs, different goals. I was on a high-level investor cruise ship where I got to speak with Robert Kiyosaki, and he was tough on the crowd. Man, I don't know if you guys have ever spent time with him, but he was tough on the crowd. And so he kind of put out some scenarios of, here's what, tell me what I want. And people stood up, you want multifamily? And he'd go, no. And someone else would stand up, you want this? And I've got this great deal for you. Basically, it was like a pitch Kiyosaki moment. And he was like, no, you're all wrong, because not one of you asked what I need. And he said, all I need, I got plenty of cash flow, plenty of money. I need tax benefits. So nobody was really, approaching him and asking that very simple question. So you have to ask yourself that too. Like, what do you need? What's your goal? It may be very different than the person next to you. And so that's why we have strategy sessions at Real Wealth Network to help you see which types of deals make the most sense for you. Investing in a fund, turnkey properties, private lending, multifamily. I mean, there's so many different things you could do. Trust deeds, tax liens. There's tons of options. So what's right for you? Now, if you're a new investor, brand new, there's a couple of things that are important to know. I mean, one is that, first of all, everything's new to you. So buying a turnkey rental property, especially if you invest with one that has a great track record, that is a very good way for a new investor to get started if you have good credit and reserves and have enough time to understand the investment, because a turnkey rental property can be pretty straightforward, but you still need to learn the basics. Now, for a new investor, investing in a fund is also a good idea because you don't have to do anything. But the only downside, in my opinion, is that you're not going to learn anything either, because someone else is just going to do it all for you. So if you're not in it to learn, you don't care, you don't want to learn, you just want to invest your money the same way you would invest it with your financial planner, and you don't need to know a darn thing about what your financial planner is doing with your money, then and you're a new investor, then a fund would make sense if you really have no time to study the investment. But whereas with turnkey properties, you still absolutely need to understand the markets and the people you're dealing with, and read the contracts, and understand the property management agreement, and all of that. Anything you guys would add to that for the new investor?
Kathy, I think all the points that you made were great. Again, for a new investor, it's about getting your feet wet, not being afraid to take action, not being afraid to do something. And, as long as you align yourself with the right group of people, you'll do very well. And again, with the professional person with not a lot of time, the fund is a perfect option for that.
Okay, so for the busy professional, like I said, a fund is definitely the better choice. 1031 exchange, sadly, you cannot exchange into a fund, at least not at this time. We would have to create a REIT, and we're not doing that this time around, maybe next year. Yeah, so a 1031 exchange, you cannot exchange into or out of a fund like that. If you were in a fund, well, yeah, you just can't do the exchange. And then you can do self-directed IRA funds, but what you have to be aware of is what kind of fund are you investing in. If your self-directed IRA is investing in private lending, that is absolutely considered investment, and so it's a great thing for your IRA. If you are investing in a flip fund, then your IRA could be taxed very, very heavily for that, because could be treated like a company if you were an equity owner. If you're just a lender to that flipped fund, that's different. So you've got to understand the tax implications of any fund that you put your self-directed IRA into, because a lot of people are shocked to find out that their IRA can get taxed. It's a just awful thing, but it's true. And so you need to talk to your CPA before investing in any fund or anything. And like we said, establish a relationship with our team. We have investment counselors that can meet with you for a strategy session. We also have a chat box. We've got 3 fabulous people on chat. If you just go to Real Wealth Network, and that counts. But we really would like to talk to you and understand what you're looking to do, and not just so that you qualify to be able to invest in the funds, but because we really do want to know what you're looking for, and if we have something that would help you. So to get to your goals faster, or maybe even you don't have any goals and you want help setting them. So you can book a free 15-minute session right there, or you see the link. Or like I said, just go to realwealthnetwork.com and go to the chat box, or sign up, join if you haven't already, and there'll be a little questionnaire and a little box you can click to meet with a investment counselor. Okay, so we're going to fly through these questions. The first one is, do you have multifamily fund programs or just single family? And I'm going to tell you right now that multifamily is in such a massive bubble. I haven't seen anything that looked good to me. I mean, it's getting harder. Obviously, if we found a really, really great multifamily deal, we'd probably syndicate it, but we haven't. I think in about a year, we're going to be finding lots of them. I think there's going to be a little bit of a crisis because people the cap rates are way too low and it's a big bubble. And when that bubble bursts, we're going to be all over it. But right now, we still are finding unbelievable, much, much, much higher cap rates in single family. So yes, that's what we're focused on. Now, guys, are we going to do any multifamily in the fund, or is it all single family?
At this point, it's going to be single family, but I'm always open as I am around the country meeting new people. If the deal makes sense, then it makes sense, and we will look into that.
Yeah, I think this one's going to target mostly just primarily single family because there's a lot of opportunities that we feel like we can take advantage of. There are some opportunities we're looking at in some aspects of multifamily. As Kathy mentioned, multifamily is peaked, and in the market as a whole, generally speaking, in a lot of your larger asset classes, there are some opportunities for some multifamily, and I think we can go into that more when we've gathered all that data.
Yeah, it's just harder to find right now. Okay, can you use your IRA? Yes, you can. I already mentioned that. Just make sure you understand the tax consequences. Make sure your CPA reads the PPM. Once we are in the fund, can we get out? And the answer to that is it just depends on the fund. So make sure you understand that the exit strategy, it should be written in the operating agreement and the PPM. Can the individual investor receive the benefit of depreciation of the real estate in the portfolio? It is my understanding that if it's in an LLC, it's a pass-through entity. And so talk to your CPA about that. But I believe the answer is yes. You guys' thoughts? Are you going to leave that to the CPA?
We are
CPA
definitely going to leave that. We're going to leave the CPA. You can, so you can get a lot of the same benefits, but again, it's on a passive, not an active level. So talk to your CPA about that.
Yep. Are these 1031 qualified? No, we have to have a REIT for that. So maybe on our next round, we will look into that. Sorry, I joined late. Are these funds only available to accredited investors? Depends. It just depends on the fund. How will the funds be priced relative to the NAV? It just depends on the fund. Will this fund have SEC oversight like a mutual fund, or it will be more like a PPM? Any fund that a small company would do, if it's not Wall Street grade or institutional, it's going to be in a PPM, but you do have to register with the SEC no matter what. Anytime somebody invests somebody else's money, you have to register with the SEC. So there's always SEC oversight. It's just not as complex as if you are a broker dealer. I would like to know the name of the Chicago management company you mentioned because I'm invested in the Chicago area. I think because it's public information, I can let you know it is MAC. They're doing restructuring. We received a notice from the owner of MAC, who, they've been a well-known company in the investment world. And so at least in the turnkey world, and now they're what we were called restructuring through a Chapter 11, I believe. But we're telling anyone who had any relationship with MAC that it's probably a good idea to find a new property manager. All right. Is any one of the conditions and not all the conditions for accredited? All right. So for accredited, it's either or. So you either need $1 million net worth, excluding your home equity, or you need to have $200,000 income as an individual, or $300,000 if you're married income. What is the difference between a real estate investment hedge fund and a REIT? Most REITs are public companies on the stock exchange. Not all. There's some private REITs, but most are public. How do and also I just did a show on it. Check out the R.E.A.L show. I asked about REITs. REITs are kind of in that category that I mentioned, where there's a whole lot of management scooping out the gravy, and the investors get the leftovers. So be careful about REITs that you invest in. Let's see, how much leverage in a fund that'll always be disclosed in any fund you invest in, the amount of leverage that would be taken on. Can you invest in Can you invest in a fund in an LLC with multiple owners? Yeah, you can have an LLC and invest, but there's criteria for that LLC that has to meet accredited LLC standards. So you can't hide a non-accredited investor in an LLC. Believe me, I've looked into it because I had a lot of family that wanted to invest in our high tech thing, and they weren't accredited, and I tried every which way, but I couldn't figure it out. So yeah, if you have an LLC and invest in LLC, the investors in the LLC have to meet the standards. If we decide to pull out of a fund, how does that work? Every fund would explain how to get out in the operating agreement. Every LLC, any company, and an LLC is a limited liability company, the operating agreement explains how that company operates. And so you've got to read that thoroughly, like Adam said, to make sure that you understand your rights. That's basically the law, is the operating agreement. If there ever was a dispute, you'd come back to what's in that operating agreement. So if you hear a presentation and say, wow, I love that presentation, I want to do what they said, but then you never read the operating agreement, and the operating agreement is different than what was presented in the presentation, it's the operating agreement that will hold up in court. Now, the court might look at the presentation, but really what you're signing is the operating agreement and the PPM. So that's what you have to look at when investing in any fund. Let's see, how many funds are available today? I'm sure there's millions of them. I'm not sure. What kind of form will you give us for tax filing purposes? Well, it just, again, depends on the way it's structured. All funds are set up differently. If it's in an LLC, and if it's in any kind of partnership, there would be a K-1 that you would receive. I don't know. I'm assuming if it's any other kind of setup, it would be the same thing, a K-1, anytime there's partners. That is it. We just got through those questions. I didn't give you guys a chance to respond, but there was, I think, one more question that was emailed to me, and let me see. I'm going to look real quick. Was should we use an LLC when investing in a fund to protect assets? That's a great question. If you're investing in an LLC, the fact that you're investing in an LLC means that you're being offered protection through that LLC. We, of course, would want to make sure that the managers of that LLC are making sure that everything is legit and current and filed properly, so that the corporate veil can't be pierced. But you don't have to set up an LLC to invest in another LLC just for asset protection purposes, because it's already in an LLC. And generally, someone said, "What can you add to a fund?" Usually you can, but a lot of funds have a close date. Open-ended funds, you need to be a little bit more wary of. Not that they're dangerous, but if you have a fund that never has a close date, there's more of a chance of a Ponzi scheme, because that means that new money can take out the old money. So you just have to be a little more cautious with an open fund like that. With a closed fund where they have 3 months or 6 months or a year to raise money and then it's closed, well, then they can't keep taking new money if they make mistakes. So usually a closed fund is a little safer. All right. So I think that is it. And if you have more questions, you can let us know at info@realwealthnetwork.com. All right, everybody, have a wonderful, wonderful rest of your day. Thank you, Tim. Thank you, Adam.
Thanks,
everybody.
Kathy.
All right.
Thanks, Kathy.
Take care. Bye-bye.